or three presentations just because there's so much information to go over. Now you can see that Pat is remote today. He's got something that he needs to attend to shortly thereafter. So we're gonna actually gonna jump right into the Brooklyn state of the market. Well, actually, you know what, Pat, if you've got a little bit of time, why don't I give the big picture New York City so people can get a big sense of the number, and then instead of jumping right into Manhattan, we'll go to Brooklyn, and then we'll come back to Manhattan. I'm sure Brooklyn will be more than happy to not have to play second fiddle to Manhattan. So we're happy to take the lead here. Okay, great. So what happened? And now I'm going to go ahead and share screen. So hopefully you all can see this. Does that look good, everybody? Okay, we're in business. Okay, so what happened in the first quarter of this year for New York City sales? We love green arrows, especially when they're, yes, pointed up. We had a 20% increase in the number of dollar volume quarter over quarter. So you can see here that we are now annualizing for 12 billion of sales. Yes, we are still well below the 10-year average of $31 billion, but we are at least headed in the right direction. You could see strong quarter over quarter growth from Manhattan. And Pat, we're going to have to talk to you about these Brooklyn numbers because the dollar volume here was down, but I know you've got a positive story within that as far as the number of trades. Queens actually having a big quarter, and that's certainly our intention to cover that borough next with its own dedicated report. Have Joe Moran here, who's a senior associate on our team, who's helped preparing the information, and we'll step in if we need any commentary from him. And then we do see Bronx, Upper Manhattan. Again, not a lot of dollar volume up there, but traditionally that hasn't been what's driving the market. So let's talk about what's happening with the number of sales. Again, some positive lift here, 476 trades. And here it is that Brooklyn saves the day with 37 trades, representing a 37% increase year over year. Manhattan did have a slight decline of 9%, less transactions quarter over quarter with 50 trades. Queens, again, and this is a trend we're going to be talking about where dollar volume in some cases might come down, but we're also looking at the number of trades that are happening. So here we see an uptick of 40% of trades. Now, if you look at annualizing New York City sales for 2024, we're at 476, still below the average of 874, the 10-year average, but again, headed in the right direction. So now with that, we're going to flip. Well, actually, let's go ahead and take a look at the year-over-year changes, and maybe we will ruin the end of the movie here for Manhattan. But yeah, New York City, again, looking at 2023 and annualizing that first quarter of 2024, we see a 24% uptick in the dollar volume. Manhattan, huge uptick, 42%, annualizing $8.66 billion in trades. I'll circle back on why that happened. Number of trades here, again, Brooklyn really helping out. So annualizing to 476 trades across the city. That's a 3% increase, but Manhattan here, the number of trades actually went down. Now, I think this would actually be a good time before I introduce Pat to give the Brooklyn numbers to also remind you all that what we are tracking now, and this is actually changing for retail as well, is that we are only tracking $5 million and plus sales. So when we talk about total dollar volume, number of trades, we're talking about the major food groups, we're talking multifamily, we're talking retail, we're talking office, development, right? $5 million and up. And then you're going to see in Brooklyn, we're actually tracking quite a few more trades. Okay, so Pat, you're on. Tell us what happened with the dollar volume and number of trades here in Brooklyn, if you want to come off mute.
Sure. So so far this year, Q1, we've seen a dollar volume of $522 million. Annualized, that's about 2.1 billion. It is easily the lowest dollar volume since 2018 when we began tracking these statistics. It's less than 50% of the 10-year average. What's interesting, and James, I think you touched on this, is that the transaction volume is actually up. We have 46 transactions annualized at 184 for the year if we keep on this track. It's a 31% increase from the previous quarter, still below our 5-year average, which should be up around over 200. This tells us one simple thing, and that is that the middle markets and lower middle markets continued to trudge along, or picking up speed actually, while some of the larger institutional transactions are less active than we've seen. Unsurprisingly, multifamily represented about 35% of the trades. I would chalk that up to not only the multifamily assets share in the building stock overall, but also to the assets performance. We're no strangers to the fact that we've had incredible rent growth in the boroughs, specifically in the last 2 leasing cycles, really the last 3 leasing cycles coming out of COVID. I think people are bullish that that will continue. We see in the news rents leveling off in the winter months, but this spring will be a real telltale as to whether we continued that story. I think we could dive into some of the comps to go over them specifically if you want to.
Well, let's talk about the number of trades. And by the way, anyone who wants to ask a question, feel free to pop it in the Q&A. And Sam, thank you for joining. You had asked when we talked about the quarter-over-quarter increase, what are we referring to? And that's a great question, because sometimes we can look at what was the similar quarter of the year before, but no, we are comparing fourth quarter to the first quarter, so you can actually see quarter over quarter, hopefully how we're building some momentum here. So the number of sales here, and Pat, this is really where you saw a big boost here as far as the number of trades, right?
Definitely. And so that uptick, again, representative of many smaller transactions than we would typically see in a given year. No surprises there, but we're happy to see an uptick in that space for sure.
Great. And multifamily leading the way with 21 trades, and then industrial with 8. We don't see a lot of industrial trades in Manhattan, so we're going to be looking forward to talking a little bit more about some of those. So let's talk about some of the top trades in Brooklyn that took place, and I know we got a lot of them, so we're going to kind of breeze.
I'll give you the Cliffs notes. So 97 grand, Whitnick purchased from Madison Realty Capital. That was an expiring 421A with just a few years left. I think we're actually going to see more and more of these deals hit the market, possibly trade. Becomes very attractive from a basis perspective to acquire assets like this well below replacement cost. That was a $457 a foot, about a 7% abated cap, but again, expiring 421A with a little bit of a rising tax burden to contend with. 269 Henry was a Carlisle purchase. I believe that was in contract for a long period of time. Low cap rate, representative of great opportunity as they saw it. On the development side, there's no real, it shouldn't come as a shock that there are not a ton of multifamily ground up development sites trading with a lack of 421A. I'll skip to the end, which is 967 Bushwick. Was a 40,000 square foot buildable square foot site, traded for about $170 ZFA, was a vested 421A site. Again, a lot of the bigger vested 421A sites not trading, people concerned about hitting their timeline, completion date in June of 2026. And so smaller deals like this still do hit the market. We are seeing them trade, but fewer and fewer.
Yeah, and I believe, Pat, just because it's a big one, the 2731 West 12th Street, I remember this one had been kicking around for a while. Industrial land, National Grid, kind of challenging site to get to, but really sold as an industrial type play. Is that correct?
Absolutely. So I think the point that I was making is that in a normal year, we would see a lot of multifamily in this development pipeline. And here we're seeing one very large industrial piece that sold to Prologis from National Grid. Again, a very long contract. The Moore Street assemblage is a commercial opportunity. That was a stalled site. It was purchased by Bungalow Projects in Fortress from Abe Leifer's company. And then, of course, the Bushwick Ave deal that I mentioned here. But in a normal year, you'd expect to see many more multifamily. Lack of 421A being not a shocker there. On the retail front, we saw a lot of some user activity and some investor activity. 25 Knickerbocker was purchased, I believe, by a user, an art gallery. 192 Prospect Park West, this curved looking asset here, was a anchored by a triple net lease with Chipotle. Very nicely located piece of retail. So happy to see those deals go through. We move on to office. 383 Pearl Street was the largest office transaction in the borough. Again, this was another user. Brooklyn Friends School actually purchased this, and it was previously occupied by ASA College. So almost a user-to-user type of transaction. And then if we move on to industrial, we can, next slide there, yep. So these were all vacant assets, which is kind of surprising. 69th Street traded vacant, possibly a bit of a covered land play transaction there. 24th Street also vacant, as was Lombardi. So I think there's a recognition in the market that if you can get into these assets, tenant them well, it's still a very, very solid business plan and one that people are eager to get involved with. On the conversion front, we had 3 deals that were all sort of pretty interesting in their own right. South Street, 6th Street was a previous theater, and that will be a conversion to residential. 232 Adelphi obviously was a church, we can tell by looking at it. Was a rental, is going to be potentially converted to a condo purchased by KSR. And then the last and final one here, 657 Fifth Avenue, was a long-time IMD asset, encumbered by Law tenants, finally vacated, delivered vacant, I believe, free of any IMD tenants, and that will be a conversion to, a residential project in the hands of a local developer.
Pat, well done. You wrapped up 18 sales in the state of the Brooklyn market, and I think under 10 minutes. So that was impressive. So
James, as a closing, I couldn't agree more that Brooklyn deserves its own report here. So.
All right. Well, thank you, and you're I know you got to run, so feel free to sign off. Okay.
Thank you.
All right. So back to Manhattan. Sorry if I'm getting you seasick going through these slides like this, but. Brandon, so this is kind of interesting. I know we were talking about in last year, you see that almost 70% of the sellers were private. We saw a lot of private activity, high net worth, foreign. I know when there's not a lot of trades, we don't want to read into these things too much, but this is kind of interesting that private is kind of swinging back to kind of what its historical range was of sellers. And look at this, the institutional sellers more than doubled, and so did the cross-border sellers. So this is kind of, could this be a signal that maybe some of the bigger institutions are willing to transact now? And if so, I think maybe a lot of our listeners would actually think that that's good news, because I think everybody's kind of waiting for the floodgates to open here.
Yeah, it's possible. I mean, I definitely would like to keep tracking it. I mean, I think you're probably potentially looking at a situation where loans are coming due, and rather than pay down the loans, it's a decision to sell. To your point earlier, it's a little bit, the sample size is pretty small, so I'm hesitant to read too much into it, just because we only have a quarter of data, but that's very possible. And then in terms of private sellers, maybe some people that, we're going to sell no matter what in 2023. In 2024, first quarter, we're anticipating rate cuts, decided to maybe hold off. Now that seeing treasuries creep back up, maybe the decision changes. So it is a little bit early to decide what that data means, but all potential options, I would say.
Okay. Now let's talk about what's happening in multifamily. And Brandon, before the Q&A blows up, I think, and I'm surprised you're not up there in Albany, trying to figure out what's happening here. So a lot of talk about good cause, a lot of talk about 421A and trying to cut a deal with the state budget being worked on today. So what can you share with us so far? We can maybe talk about the 421A piece as we talk about development, but just for good cause, what are we thinking here? What can we expect?
Sure. So the two ideas, and again, I want to preface this with it's so early and we don't really know much of anything. We just have heard things float around. would be, good cause eviction with, in terms of rent growth, it would be capped at the lesser of 10% or 5+ inflate or 5+ CPI. And then in terms of IAIs would flip over to 30,000 instead of 15,000. The real estate community is going for 50,000. So a compromise of sorts. I would say my biggest concern, and I talked to you about this earlier, is starting to see a fraction amongst multifamily owners. So you have the owners of, call it rent stabilized product, and you have the owners of luxury product, and it appears as though agendas have kind of diverged, and I don't think that's good for the real estate community because everything needs to kind of align. So that's one thing I'm sort of tracking. But yeah, it's early. Let's see what happens. I don't want to make any guesses, but those are kind of what's being floated out there. I think any kind of legislation is.
Yeah, and Brandon, I was even going to say that REVNY's even saying that they're still reviewing. I mean, this is happening live right now as we speak, so it's evolving. REVNY certainly needs to weigh in. If we're talking, we'll talk more about their thoughts on 421A and what's happening there. Brandon, the only thing, and again, just that I had read is that maybe there's going to be an exclusion if there is good cause. Will certainly luxury units be cut out? So we don't, doesn't sound like we know at what monthly rate that would be, but that maybe that would be some kind of trade-off.
And that was the divide I was referencing. Because I think any exclusion is a positive for real estate, in my opinion, because there's no benefit from having more groups put under legislation. I think the biggest thing there's no negatives adding more groups. I think the biggest thing, if it were to go through, I think it has a much bigger, my guess is in the short term, I think things freeze just while people digest everything. I think in the long run, it has a much larger impact on value add buildings because it's impossible then to time your investment. That is where I think it's going to be interesting to see how that eventually settles. Less so than the renovated apartment buildings where, if you get 10% rent increases or 8%, it's more of like a California style. I don't think it's as impactful. In terms of, the numbers and the metrics, I mean, you can see here, it's such a small sample size. There just weren't that many. There was only 20 sales, which is on the low end. Dollar per foot is down 25%. Cap rates up. I mean, I think this gives a good barometer. I think every sale is so different. But yeah, I mean, to your point, we had the dollar volume jumped because the air sold, which was like the first big apartment building to sell in a while. So I can quickly run through these. I'll be a little bit faster than that. So 200 West 67th Street, that was a private family that owned it. For a variety of reasons, they elected to sell. There was debt, there was family dispute. The buyers, Carlisle and Gotham, generally can view Carlisle as a low cost of capital buyer. There's ways to implement some light value add strategies. I mean, there's a lease up in general, management efficiency, potentially charging for amenities. I think at the end of the day, this will look like a great investment, great location, great asset. So that East Village portfolio, that was Kushner to Penn South. I think just for everyone's, for notes, I mean, that was well into the, mid-6 cap with assumable debt, IO for another, call it 5 years. So again, that came with assumable debt, which led to a high cash on cash. And that was something that the buyer was excited about. Potential cap rate compression makes that deal look like a home run. 120 and 125 Riverside. So that was Bentel Green Oak, heavy rent stabilized component. That was purchased by an Israeli buyer who has been very active. They took a major haircut on the sale. I want to say off the top of my head, it was 64%. So just, again, I think it just drives home the point that rent stabilized housing has taken a beating in terms of cap rate compression, cap rate expansion, combined with higher interest rates, it's just, you know, it's a recipe for losses, unfortunately. If you have to refi that property unless you're willing to put a lot of cash in.
Brandon, do you have any cap rates to report here on these trades?
Yeah, I can pull it up. I should probably have it in front of me. 200 West 67th, there was a lot of data floating around. I think depending on whose numbers you can look at, you know, because their NOI had a lot of there was a lot of vacancy in the building at the sale. Assuming fully leased, you're north of a 5 for air. I can pull up.
While you're looking for that, I
Sure.
can talk about the land sale market, which is, you know, again, maybe this is kind of the theme. When you have less than 10 sales, it's tough to read too much into these. But here you've got a price per buildable of 464. This is an interesting slide. This actually shows in Manhattan the land sales how much total buildable square footage that these sales produce. So, you know, going back to 2007, you know, peak market. You know, almost 10 million square feet of development sold. Now, you know, next peak 2015, 9 million square feet. I mean, since 2019, certainly since COVID, I mean, there was a little bit of a bump, but, you know, 3 million square feet, now less than 2 million square feet that these sites are representing. Again, this is a far cry, and obviously this is just, you know, Manhattan, but you talk about kind of the type of demand that was out there before. And a lot of these big, a lot of the square footage, a lot of this was geared towards multifamily development, rental development. Now without the 421A, as we've been saying for a while now, that it's really been the barbell, where in Manhattan, it's for condo development, in the boroughs, fully affordable. So the kind of trades that we're seeing are all, you know, the one on the far left and right, these are both condo developments. The one in the middle, believe will ultimately be condo, but that was a distressed sale that was kind of worked through. Brandon, I don't know if you want to say anything more about the first two. I have some more insight on 1128 Madison if you want.
Oh, sure. Yeah, I mean, 252, 258 Third Avenue, that was you know, same purchaser as Madison Avenue. So Victor Segura Legion, north of 1,000 of buildable high-end condos, you know, projecting sellouts north of 4,000 a foot. That was sold by a private owner who's exchanging into triple net properties. 616 11th Avenue. So that was also, you saw 175 Spring. So this is an old Bob Gans site, Metro Lumber, taken back by Extel and Princeton Holdings. So they sold the site actually to a developer out of Brooklyn for like 222 a buildable, I want to say. So you have to imagine a rental project over there. You know, maybe betting on abatement coming back, or just feels good about the fair market rents at that basis.
Yeah.
I
Now,
can,
yeah.
I can quickly just give the metrics on that at the Kushner stuff. So the Kushner 6.5 cap going in, 11% rent stabilized / rent controlled. It was 966 a foot, but the biggest thing is the buyer assumed the seller's 3.77 interest only loan through 2029. So that was the big driver there. There was also, we talked about, what was
Riverside Drive, yeah.
Yeah, so Riverside Drive. So this one I have here, it's that was just in front of me. Sorry about that. Oh, here we go. So 281 a foot, 63% rent stabilized / rent controlled. I would say of note, you know, again, just there was a massive reduction in value over the years since it was purchased. And then, yeah, that's about it.
All right, and I know Scott's got a lot to say, so I'm going to breeze through retail, which averaged a 7 cap, the price per foot coming down to low thousands a foot. But as we see, this really, you know, is pretty volatile in the sense that a couple large sales can really skew the market. Now, that being said, we did elect to take out the largest sale, which accounted for almost half Manhattan's dollar volume, 719 Fifth Avenue, purchased by Gucci, not to be outdone by Prada. So Prada pays $800 million last quarter. So Gucci $963 million, and the parent company Kering, I believe, also just acquired a property in Milan for over $1 billion. So luxury retail definitely seems to be on a spending spree here. We have a retail condo at 401 East 60th Street. Brandon, I don't know if you hopped off, but I think you had this was Gazette Holdings with the trade there. And then the last one at 110 West 32nd Street. This was a distressed sale that was purchased. The entire building was purchased for $35 million. And the buyer of that just spun off the retail for $30 million alone. So is into upstairs, the office for, I think it was actually $6-7 million. I'm going to convert that office to resi. So that seems like a pretty smart deal by that buyer. That was Tony Park who executed on that. So Brandon, any more thoughts on 401 East 60th Street on that trade before we move on? You're on mute right now.
Yeah, so that was a 5.9 cap. It was occupied by Home Depot and Starbucks. I mean, great space. It was previously occupied by Bed Bath and Beyond. You know, it's fully occupied, just strong retail.
Great. Okay, office. And I've already told our research team I want this 4.5 cap rate to basically disappear from the chart, because there's so few cap rates that we're reporting now. Most of the office that's trading is either mostly vacant, significant vacancy. You don't see a lot of core office, fully occupied, long-term WALT. So, what happens is, one or two of these sales will kind of keep this, 4.5 cap average alive. But I think this is going to be something that we're going to put in the history books here in a while. And we also promise you for next quarter that we're going to actually bifurcate the price per foot on trophy A, B, and C office, because $659 a foot, sure, we can sit here and say that it's kind of held since the previous quarter, but what you see is huge variances in the price per foot. Again, this trend of end users buying office, I mean, that was definitely the story for last year, still continuing. A tenant in 211 Center Street buys the property for $51 million. Actually, all three of these trades, how telling is this? These are all end users. So, Brandon, I know you reported on these as well, but you want to give us the user groups that were acquiring these properties?
Sure. So Center Street, I mean, that was close to 1,100 a foot. So that was the Museum of Chinese in America. They were tenants in the building, and they purchased it. 545 Broadway. That was the Brandy Melville purchase. That was just over 1,100 a foot. 25 East 22nd Street. Well done by our old colleagues over at CW. So that was purchased by a Japanese publishing and comic book company. It's going to occupy the building. They paid $15.71 a foot. So that was a big boy.
Wow.
Yeah.
Perfect. Okay. Yeah, but all three office purchases are users, so obviously no cap rates assigned to any of these transactions. You can look at the historical pricing, which continues to looks like kind of adjust downward, although nothing, with the exception of retail, as we mentioned before, is as volatile. So looking at cap rates, you're seeing some serious expansion, and certainly for retail now, looking at some cap rates north of 7%, pretty remarkable. But Scott will tell us where the borrowing costs are and how that correlates. Multifamily now at 5.5%, and as we start breaking up the fair market and fully rent regulated multi trades, sure, you'll see a huge discrepancy there as well. Not too similar with the different types of office buildings that we'll report on. So the question is, end users have really been the saving grace for a lot of these office purchases, how deep is that well? What happens when some of these larger assets trade where maybe they have long-term leases or even some WALT that would make it difficult for an user to take over. Obviously, we're watching very closely with what's happening with good cause eviction 421A. We will certainly let you all know as we get some feedback. And then, these loans coming due, are these going to continue to force a lot of these sales that are taking place? So we did Brooklyn. So with that, Scott, you're up. We managed to cover everything in 30 minutes. I know Brandon was scrambling a little bit for his notes, but that's okay. We're still, maybe we're at 12:32. So we apologize for a 2-minute delay. You're on.
No worries. I will roll quickly as well. So I think, James, you can go right into the next, and these first couple slides for anyone who's been following these the last few quarters there, I'm putting the same ones up just to say we've been in this dislocated period since 2022 when 5% sounded high and then 6, and then there was 7, and when we put this slide together towards the end of last week, it was more 6, and now suddenly treasuries are up 40 basis points in the course of last month. So we remain volatile. I think, James, if you go to the next, this is a slide where we look at where the 10-year treasury has been since 1962. And I think the question has always been what's coming next and where are we? And within this slide, the average, and we showed this on some prior ones, has been about 4 3/4 for the 10-year treasury over the last 60 years. And so we had this period of time in the 70s and 80s when they were much higher. And we had this period of time, which was more limited in the last 10 years or so, when they were much lower. But we still remain below the historical long-term averages. And for anyone or everyone who saw Jamie Dimon's note last week, this is really what he was pointing to as well. The fact that we got used to very low rates doesn't mean that they necessarily will return. James, if you go to the next one, this is our comparison we've shown before between Treasury and SOFR. And what I always pointed to here is that the purple line that's more moderated is the Treasury, and the blue line with the quick ups, short peaks, and often quick downs was LIBOR, and now it's SOFR. And within this, the question on everyone's mind: when will the Fed start cutting the short-term rates? I think there are real pressures, competing pressures on them now, and the talk of higher for longer and whether there will be any cuts this year. And when they will start, in my mind, makes a lot of sense. My own feeling is that cuts are not coming soon and are not coming fast unless outside forces require it. James, if you go to the next, getting into the forward curve, which we did show the last time. So the forward curve is created by traders who make their living by betting on SOFR and Treasury rates and the interactions between them. And I think this is a really interesting slide again to look out here. The SOFR is this navy blue line that starts out high at the top left in the 5.5, 5.25 range, and does drop. And so that's the projection of the cuts that the market believes that the Fed will take. But if you look at it, it takes about 1.5 years. It's hard to see at the bottom, but that spot where the SOFR line hits the 3.5 is 2026. So 2 things on that. 1, that's a couple years out, and 2, that's only 3.5 as opposed to the 0% that we all got used to before. And then there's no more decrease that the people who bet on this every day are expecting. Similarly with treasuries, the blue line is the 10-year. That's a little bit higher, although they're basically equal now. And in fact, over the weekend, we could bump both of those up to the 450, 460 range. So the expectation before the weekend, even without that raise, was that there was very little decrease coming in treasuries, and that we were staying here at a level that's 300 basis points, 250 basis points above those all-time lows, and we seem to be moderating back towards the long-term historical average. All right, James, if you go to the next. So, what's happening now? What we see, and especially in the last 3 to 4 weeks, is a massive uptick in activity among borrowers for refinancings, among developers who want to get started, projects that have been sitting and being talked about. Suddenly, there just seems to be far more activity, and I think it's FOMO to a certain extent. Maybe that's a catchy way of saying it, but more a belief not only among interest rate traders, but among real estate participants that rates are probably not going to drop dramatically. And the worry that existed and created the lack of transactions from the late 22 into farther into 2023, the concern of how high rates would go, we may have moved off of that as well. And so we've seen that that there's capital available for any transactions that make sense all across the risk profile. We're getting some very low spread deals done on low leverage assets. We are seeing a lot of interest from higher risk, higher return money, just really overwhelmed with a supply of that money that wants to get put out but hasn't seen enough deals yet. And it does seem that we're moving towards the middle with that so that deals can get done. CMBS, I think probably for the rest of this next couple minutes, I'm going to talk about CMBS in that we've seen CMBS come back very strongly, especially in the last few weeks, and even for office. And so we just pulled over the weekend. This is 7 trades, mostly CMBS on office buildings. And there's a variety of, some are lower leverage and some were not. But I think the fact that had we been talking about this, we were talking about this, a couple months ago, the likelihood of doing an office loan in a CMBS pool was very, very low. Now, if you go to the next one, James, I took just a look back. CMBS was created for a market like we've had over the last 18 months. In the early 90s, there was a vacuum in capital available. There was a banking crisis. There was a liquidity issue. I've probably said this before here, but my first day working in 1994, the group of brokers who were in the business already had the assignment over the weekend to make a list of all the lenders who were in the market for anything. In New York, and it's a really short list. It's about 12 players. So there was no liquidity then, and the CMBS market was a creative way that Wall Street came up with to bring the supply of capital back into the market. And I think we're seeing the same thing. We've seen the same thing happen, that as things really slowed down last year, CMBS got creative. The 5-year Treasury, 5-year fixed rate CMBS market emerged. The SASB market is back, and that group on Wall Street is really, really smart at figuring out how to bring capital into the market. And the great thing about CMBS for this market is that the supply is essentially unlimited when the demand is there, and the demand is there. So I think my last slide is just the next one showing historical CMBS volumes. Maybe a little hard to see. The right side is full years going back to 2024, and digging in. The average sort of normal year of CMBS volume has been in the $80 to $100 billion range. And there was only less than 40 billion last year. Virtually all of it was in the fourth quarter. There's 18 billion dollars already in the first quarter. And I have to imagine, given the volumes that we're seeing and what we're hearing, that the second quarter is going to be dramatically higher. So, in summary, I think we're in a period of relative stasis in index yields, without any real big drops likely, except as a result of outside forces. There's no obvious organic reason for borrowing rates to drop dramatically or necessarily to rise. So this may be self-serving, but I think it's a time for borrowers and developers to act when there are deals that make sense to do. Now's the time. And that's as much as my voice can take.
Oh, thank you. That was even tighter than what we put forth. So that was really great. And it's interesting to me, the parallels between the investment sale market and the CMBS market, because when you start looking at those historical averages, I mean, I was looking back to, 2015, when there was over $220 billion of CMBS. So you look at last year, you say, well, that was only 1/5 of peak, and we could do the same thing for the sales market. But you look and historically about what kind of appetite has been out there, and again, if we could even get back to kind of a more 10-year normalized rate, there's a lot of appetite out there. So I thought that was great. We did get several questions about, yes, we will provide the deck for those who sign up for this. So Savannah, who's been fantastic, who does our marketing, will make sure, and Julia will make sure that you all get copies of this. And then John, you asked the question about, have we seen any resi conversions of office buildings? Not in this past quarter. Again, those 3 significant office trades were all acquired by end users. I just got back from the ULI conference. Well, I didn't get back, it was here in New York, but sitting in on the ULI meetings and talking about resi conversions. And I saw GFP's presentation on 25 Water, saw Van Barton's presentation on 180. A lot of these were already in the pipeline. We know there's some other, large resi conversions planned, but again, what they all have in common is that most of these buildings were purchased at sub $300 a foot. All of those office trades that we just shared with you, 1,000 a foot, 1,100 a foot. Again, when you have users willing to step up at that basis, it's not going to make sense to convert it to resi unless if we're talking about a super premium location where you can sell condos. I think there was also a question about, have we seen any commercial development? Once again, the answer is no there. I certainly haven't seen any spec office taking place recently. If you were referring more to hotel development, I saw the stat that since the city put in place a special permit to build hotels, which I think most would say is kind of a requirement to build a union product, that there's only been 1 new hotel built. That could certainly be a whole nother webinar on the state of the hotel market and opportunities there. What I would tell you quickly is that the number of keys in New York have been substantially reduced, not just from resi conversions, but from migrant housing, which I've heard estimated at between 15 to 20,000 keys, which brings the New York City hotel stock from about 100,000 keys down to, call it, 85,000 keys available. So as a result, you see ADRs going up, and as well as occupancy rates. So again, if you have more questions, put it in the Q&A. Scott, I actually want to bring something that your father told our group, which is, yes, the 10-year Treasury is up, but maybe some good news, at least for multifamily, is that the spreads are tightening. So maybe talk a little bit about why we're seeing that in the multifamily space.
Yeah, I think it's competition. I think that the lack of deals and the lack of has caused, there's a need to get money out. I think where he's been seeing that is on some deals that are quite attractive. And we're seeing spreads pushing down to, again, what's been historical norms. I think the lowest spread I ever did in my career was 12.5 basis points over swaps at a time when swaps were about 50. So that was 62 basis points over treasuries. That was a total outlier, but a normal range of lowest spreads has generally been in the 125 to 175 range in a normal market. And there are no 125 spreads out there, but there's 150 and there's below for the best deals. And so that is, again, I don't see a lot of downward movement in spreads for lower leverage deals. And CMBS pricing is, CMBS I think is winning deals by being the source of liquidity now, but it's not at exorbitant rates. So if CMBS deals are getting done in the low, for the more challenging deals or for the office deals in the 200s and certainly in the for multifamily well south of that, then again, that's a time when it's from an historical average perspective, it has become a reasonably attractive time to borrow again. Now, if you can sell deals, if you can be selling deals at 3 3.75 cap rates, then this is a problem. But I think that we've seen that changed, that the market adjusted and cap rates adjusted to the higher rates as well. And 3% cap rates were not a historical norm either. So I think we've come much closer. If anything, I think the cap rates now still are well below long-term historical norms.
Great. And that's a good segue for Brandon. And this is coming in from an anonymous attendee. Brandon, this might be Joey Kosum asking this question. He wants to know, what is the difference in cap rates and price per square foot for fully rent regulated and majority fair market? And I would just caveat that by saying we don't see fully regulated buildings in Manhattan. I mean, that would be pretty rare. I think, if we want to talk about in the boroughs, we certainly see some of that. But Brandon, if you want to come off mute and tell us, what you would say to cap rates and price per foot on regulation and price per foot.
Sure. I think the first thing I would say is we spend a lot of time. We have our own internal reports for that, track every single sale in the city. Percent rent regulated, cap rates, information about those sales that we share with clients. So if you are one, feel free to reach out and we can go through it. Generally speaking, for price per foot for the multifamily product that has, call it 65 to 100% rent stabilized, you're generally seeing, again, it depends on the situation, but you're generally seeing price per foot somewhere between 250 to 350 is where I've generally seen those trades. Once you're looking at majority fair market, I think something else to consider is what tax class is it, right? Because if you're looking at a tax class 2A, 2B property, the taxes are very low, the price per foot organically gets pushed higher. But you're seeing these value add properties trade anywhere between, call it 500 to 700 a foot is kind of generally the sweet spot for majority fair market value add. And then, ourselves included, we're going to close on a majority fair market 24 to 25 elevator building renovated in Manhattan. Candidly, and we've done a number of these, it's hard, but that'll be on real numbers, a sub 5 cap. It's a 5 cap on our numbers, approaching 1,200 a foot for a tax class 2 building. It's so dependent. It's a very, I've said it a million times, it's a black and white market. So for the value add stuff, it's challenging because there's not many people out there with equity. So it's a pretty small buyer pool. There's a lot of people that want to buy, but can they actually raise the equity? It's been challenging. And then on the renovated stuff, it's a lot of buyers from overseas, almost entirely, very few 1031 buyers, but there's some. And they're willing to pay, a 5 cap. It's just that there's, I always used to say for every one renovated buyer, there's 15 to 20 value add buyers. So take that and then shrink the buyer pool more. It's just a needle in a haystack that was already a needle in a haystack. So it's just a lot of work, but if you find them, you can still be successful.
Yeah, and I know that the Japanese buyers who've been incredibly active as of late really want to see that majority fair market building. But since we have Joe here, and Joe, I'll put you on the spot here. A fully regulated deal. I know we were looking at one in Queens, and kind of the buyer appetite. If you want to say the bid-ask spread, that a lot of what the buyers were looking for to buy a fully regulated building, what kind of cap rates were they generally looking at, or is it price per unit?
Yeah, I think the biggest driver with these fully rent stabilized deals is your top line, which is your gross rent multiple. So, the one in the story that we had just sold, 2519 30th Drive, this was a low rise building, very little capex, that sold for 8.5 GRM. Whereas, if you find, if there's a lot of day one capex that has to go into it, that number can go as low as below 6, where you see sometimes in Upper Manhattan and the Bronx. That being said, a lot of these rent stabilized buildings with little capex are trading at, neutral leverage. The one we sold, if not negative leverage, the one we sold that I just mentioned in the story was a 6 cap, and the buyer told us, he got debt at 6.5%. So he's, long-term view. They're not looking to, buy and flip and wait for cap rate compression in a few years. It's really, holding for 20, 30 years, like their parents may have bought a building, in the 90s, wherever else. They're seeing those opportunities today at low basis.
Great. Thank you, Joe. You nailed it. And I will say that the types of buyers for these fully regulated buildings, of course, are taking a longer term view and hoping that the pendulum swings back. And obviously not a whole lot of great news coming out from Albany, but Brandon, as you mentioned before, if there's an increase on what the AIAs, did I just reverse that? AII, that's the architecture thing. Yes, the reimbursement for improvements, they're talking about in increasing that. So, Scott, did you want to have some closing words? I have one last thought before we close, but if you had something else, feel free to chime in.
Not really. I think I did it. James, go ahead.
Good.
Bring us out.
So the closing thoughts, and the one thing that we did not talk about was the Blackstone acquisition of Air Communities. And although that wasn't, an individual asset that we would, talk about in this format, but certainly a huge vote of confidence for those of you who read the Journal article and, the way that Blackstone was viewing this, the Air portfolio, and some of you might recognize the name Aimco more. At a point, there was a split between the Aimco assets and Air. Air being the higher quality, newer construction assets, fair market, and those were mostly in gateway cities. So there was a lot of chatter last week at ULI about how positive of a sign this is for the gateway markets, for multifamily, that Blackstone getting off the sidelines, if I'm not mistaken, was it a $10 billion acquisition, looking at what that cap rate would translate to based on the takedown price, the premium on that stock price. I've heard reported between a 5 and a 6 cap, but somewhere in that range. But again, a huge vote of confidence for multifamily in the gateway markets, because we know over the last couple of years, a lot of the institutional appetite has been focused in the Smile States. So with that, I think we made it a little bit early. What will give you all 7 minutes to go onto your next meeting or next thing. And as always, we really appreciate the opportunity. You're joining us. We had a great turnout for this. We'll have this deck for you. And as Brandon and Scott said, if there's any individual questions or things that you need our help with, we're here to be of service to you. So have a great day, everyone, and look forward to being in touch.
Bye, everybody.